It is that time again, once a month, when Cathie Wood gives her report and her analysis of what's going on in the economy, what's going on in the stock market, et cetera. Larry at Goldberg and I, we get together and we go over what she said, and we try to add our own little analysis on top, but mostly just make what she said more uh, available to everybody that may not be quite as up on all the stats and the reasons for them. So, Larry, any
Hey, Randy. And I think it should be said that, people should really take the time to actually watch Cathie actually deliver her in the know. I think she adds huge value. I mean, I hope we add some value, and our views are probably not as well informed as hers, but I think we both have a little bit we think we can add. So, anybody who wants to follow us is welcome to, but I think that the real source is Cathie.
absolutely true. And we're obviously extremely big fans of Cathie Wood, both from just from her intellect and her huge amount of knowledge in terms of following the economy. She is actually an economist, which Larry and I are not. What we would hope maybe to bring is that practical side. Both of us have owned companies and dealt in international trade our entire careers, and so there's some kind of flavor that comes, I think, from that. So,
We
with
have we have the we have the wounds to prove uh, our practical application of these economic theories.
the wounds for sure. So, Larry, if you want to share your slides, we can start digging into what Cathie came up with.
Yeah, yeah. So let's see if I share my screen and this is interesting. Every day is an adventure.
That's right. Technology can't live with it. Can't live without it.
That's right. So, this was from March the 8th. I guess yesterday was the the drop of the employment fee of Employment Friday. And let's see what we've got. So we start with the introduction, and Cathie always focuses on total debt. And why does we focus on total debt as a percentage of GDP? Because it's at record levels. Well, almost record levels. Record levels was during the pandemic. And during the pandemic, both Trump and Biden just opened the spigots. And the Federal Reserve opened the spigots. Everybody opened the spigots. There was fiscal and financial and government expenditures of unprecedented proportion.
Right.
And right now,
And worldwide. Yeah. And worldwide, not just in America, but everywhere. Yeah.
yeah, everywhere. We just kind of we were like sheep following in the footsteps. And I guess it all began with China, and we kind of followed China, which is regrettable. I think there were probably better solutions, but it is what it is. So, we're at an incredible level, and I think Cathie made the point, and the most important point is that this is unsustainable, because right now, very shortly, interest will consume almost all government revenues. And at that point, it'll be very difficult. We're at 15% of total spending on interest payments. So if you take this line and you continue it up any further, it's going to be pretty bad. The other thing I'll say is that just look at where we are compared to 1980.
Yeah.
I mean, 1980 was kind of the Goldilocks from I would say 1985 to 1990 was the Goldilocks period of economics. And you even see, I mean, at the end of the Clinton administration, in the last 2 years of the Clinton administration, going into the Bush administration, our debt was actually declining.
Yeah.
And a very significant rate too. I mean, we declined from a peak of 65 to 55, like a 10% decline. And economic environment was extremely favorable. But look where we are today. Look at this gigantic spike. I mean, it's like a Second World War spike. I think the spike may have even been higher than the Second World War in terms of its jump. Anyway, enough.
Yeah.
My
Well, no, I mean, this is I think that this is not talked about nearly enough. I think that it's not part of the discourse going into the election. Maybe that's unsurprising because presidential candidates don't like to talk about things that they're not prepared to step out and fix that's going to have negative consequences. Because in order to fix this, there usually has to be some pain. There are other ways to fix it. I mean, the way they fixed it in the 1980s was not, and 90s was not that painful. But Cathie talks about the biggest way, the fastest way to fix it is through growth. She believes it will be solved as a result of growth, and she believes that'll happen as a result of all these innovations that are coming along that will create a massive amount of productivity. As productivity goes up, you do have a chance to outgrow. We do this individually. People outgrow their debt by increasing their income without increasing their spending. And that becomes the method that Cathie is suggesting will happen over the next few years.
Yes, and that is borne out by the reduction in the late 90s and the early 2000s of our debt, when we saw this gigantic growth of the internet, and it had huge implications on productivity in general.
Right.
I thought the 80s was going to be a very big growth of productivity because of the computer revolution. But really it took the mid 90s with the internet to really make that happen. And Cathie really focuses on that as the Deus ex machina of solving this problem. And she talks about the 5 great platforms of innovation. She talks about robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life sciences. Those are the 5 great platforms, and they kind of interact. They all connect to one another, so that's the principal thesis of ARC, and it's what is so exciting about ARC. We'll circle back to that at the end of the talk, because she talks about a paper that they're about to produce on that theme.
Yes.
So let's start. She starts with monetary policy. Sorry, did you have something to add on?
No, that was it. Nope. Yep, you're good.
Okay. So we start with money, M2 money supply. And, this is the key slide. You could almost present the slide and say that's it. Because this just shows the relationship of the price index, cost price index, and money supply. Now, what they've done is that the money supply is actually coming 18 months before the CPI changes.
Right.
So they've moved they've moved those 2 graphs and slid them together. So M2, that is the money supply, is leading by 18 months. So it's slipped. We've moved the graph back by 18 months.
Right.
And you see there's an almost perfect relationship, perfect correlation between what happens with the money supply and what happens with the with inflation. CPI is functionally inflation. And you know, money supply has collapsed.
Right.
And so with the collapse of money supply, what do you think is going to happen?
Typically, then your CPI would go, your consumer price index would follow. It has been following since 2022 when it peaked and started down. And she's saying that it'll continue to follow along here. And there's plenty of evidence for that and some other charts we'll be looking at.
So when inflation collapses, we get deflation. And I promise you, deflation is many times worse.
Yes.
Think the 1930s,
Yes.
many times worse than inflation. So if inflation is the bogeyman that the Federal Reserve is all about, and this is why they're crunching down, they're keeping interest rates so high, what are they going to do when deflation hits? You know, simply printing money doesn't really help in deflationary times. So this is a pretty serious situation. And it troubles me. It really troubles me that the Federal Reserve is so keeping their heads. It just boggles the mind. Anyway, I've vented as so often on this program about that. And do you want to add anything to that?
No, I'm good. That's it.
So now we can look at the federal funds rate, the real federal funds target rate. So do you want to opine on this?
Sure. What we're looking at here is you have the real rate. Okay, the real interest rate is the difference between the CPI, and actually I think she might have been using the PCE on this one. I can't remember, but whether you use the CPI or the PCE, you come up.
This is CPI, right?
CPI. Okay, so she's comparing the CPI to the federal funds rate.
Right.
And she's saying that right now the difference is at about 2.5, 2.6, somewhere in that range. 2.7 is the difference between the two, which is a very high number. Historically is getting into a very high number. Well, as disinflation continues, if we get down to 2%, 1.5%, 1% in terms of the CPI, if the federal funds rate stays at 5.5, 5.25, then all of a sudden you've got historic highs. You jump to 5% real rates of interest. Well, the market never allows that to stay very long because the greed curve comes in and the investors will say, well, I want some of that 3% money or some of that 4% money. So that's not going to stay in place for very long. But what she's pointing out is this is another indication that the Fed needs to move. The markets will move, but the Fed should be moving.
Yeah, so you only have to look at, whenever the rate really goes in these positive rate in these areas, you really have periods of problems. And in the period of great calm and quiet, you have you have this kind of normalcy. So it's a problem. It's going to be a problem. It is a problem. So now we look at the yield curve, the 10-year Treasury minus the 2-year. And it is actually getting closer to the zero mark, but it's still negative. And you'll see that, it's very seldom that it actually gets to negative, that we don't have a serious, and these are periods of real pain in the economy, real pain, because this is where you have everything. Wow. What happened?
I don't know.
I think we're gonna have to. Sorry.
Yeah. So we report this every single day in both the morning program and the evening program. We talk about where the yield curve is because we do believe it's important. And right now, that particular yield curve inversion is at about 0.4, about 40, I'm sorry, 40 basis points. It's been around 40 basis points for a very long time now. You see it dip down a little bit more, almost to 100 basis points, but then it's come back to this level around 40, but it's just not making any move towards zero.
And so, you can expect that, when you have this dip down there, you're going to get a recession. Now, there was a recession, early in the, or at least there was a declared recession early in the pandemic. And I think they cheated a little bit. They kind of reclassified what they consider a recession. But I think we're really faced with the high probability of recession based upon, if you look at the pattern, every time we dip, we get a recession. And of course, we had a very serious series of recessions in the 80s. So
Right.
that's the importance of the slide. So, and then, we go on to bank term funding program as a total of outstanding debt. And, this is an indication of pain in the banks. And we're seeing this probability of pain in the banks arising yet again. We've just had a relatively small bank be taken over by the Fed. And there's a high probability that we're going to have further pain in many of the regional banks. That's what the slide is showing. That's what happened in 2023. It's happening again. And so I think if we look at the bank term funding, how much the Federal Reserve is providing local banks or banks in their funding program, emergency fund program, we'll see that there's a potential probability of further bank pain.
And this program ends Monday. So
this program, it's supposed to end on Monday. It may actually be extended, or if not extended, they may have to reinstitute it if there's further bank pain. Right, so now we move onto economic indicators. And economic indicators are where we look at the figures we're getting from the economy and what that indicates for the future economy. And so this is actually one of the most important slides or most important indicators that Cathie looks at, and that is this whole employment thing. Now, you've heard Randy and I get very excited about the employment numbers being reported month after month, as they were on Friday, with month after month revisions of the previous numbers, which lead us to question what's going on with the real numbers and question the numbers at all. And what's really interesting here is that Cathie imposes the temporary help employment numbers onto the total non-farm payroll numbers, which indicates that really the temporary help employment is really what is showing as employment, or what the government is reporting as employment. And when you get temporary help rising at such a high rate, it's really masking the real employment situation. In other words, for real, the employment situation is not as good as may be indicated. And so this is a very important indicator. This total non-farm payroll rising at the rate it is probably going to fall precipitously, is what this indicates to us.
Right.
Add to that, Randy, do you agree? Do you disagree?
Yeah. So one of the things that is totally underreported, Cathie talks about this. I've been talking about it because I used a lot of temporary help. I know how this works. And what happened during the pandemic is that there was such a labor shortage that people were scrambling for help any way they could possibly get it. And where do you turn? I was telling my clients, I'm a marketing consultant by trade, and I was telling my clients, go out and go to the temp help places. Well, they went to the temp help places, and the temporary help people said, we don't have any people for you. So this spiked like crazy during the pandemic. And then there was such a shortage that companies started over hiring. They hired people they didn't need because they knew that people were going to leave. People were changing, moving on within a week or within a month because they had an even better offer. So these companies overhired. Well, once you start overhiring, you can see that this trend started downward in 2022 while we were still in that shortage situation. And the reason that the shortage, they started trending down at that point was because these companies had way too many employees. They didn't need temporary help. Well, now, as they're starting to actually shed some of that excess employee base that they had, and we'll talk about that in a minute, as they're shedding that, well, they certainly don't need temps when they're also starting to lay off that excess baggage that they took on.
Yeah, the other thing is that if you look at another report, temporary household or household employment,
right?
You see that household employment. This is not on this graph, but household employment was down about 185,000 over the last 3 months.
No, 185,000. No,
Over the last 3 months, dropped over 1 million. I think
million, over a million. Yes.
over 1 million, she said, and that may be a better indicator than this total employment that's being shown. And it may be the reason why this total employment figure is kind of lagging so badly. But, Cathie made the point that the UN really actually reports household employment, total household employment, rather than these government figures. And so I think it may be a better report in terms of to calculate the unemployment.
Right.
Because that number is more sensitive to small and medium businesses, to Randy's point.
Right.
So now let's look at the job quit rate. Well, the job quit rate is it's quite telling. You'll see that in COVID, the quit rate went all the way to the moon. I think that, led to, this very high unemployment, this very high temporary employment situation. And so it's kind of a spike, and that spike is dropping very rapidly at this point.
Yeah, when people are not nervous, when they can see that they can move easily to the next job, then they can quit, whether they're dissatisfied or whether they're just quitting in order to go on to something better. But we're now in a situation where that opportunity is no longer there. The likelihood that people are going to move to a higher paying job now after they've moved 2 or 3 times up already in their career, not as great. Moreover, they're probably been at their company long enough now that they're starting to say, I like it here, or I don't. There's more of a chance to have worked into a situation where you've got friends and where know your way around, understand your job. So this is natural that this would come down like this, but it's also indicative that we're getting back more to normal, and it may go down further. As you can see, it can drop a lot from here to in a normal economy.
And this could be very volatile, so it's worth keeping a focus on it. This quit rates if you see the volatility of it, it's incredible.
Well, the Chairman Powell has mentioned it a couple of times. He pays attention to this one.
Yeah. And then now we look at home sales, and this is a very, very fraught area, existing home sales. I mean, we're close to bottom. I mean, the lowest was this, 2010, 2011 collapse. But I mean, look where we are right now. I see a slight uptick actually, which is interesting. But I mean, this is recession level home sales, right?
Yeah, so but we have to keep in mind the reason for it. So the reason for it is people are locked into their 2 and 3% mortgages, so they don't want to move. They're not putting their homes on the market. So it isn't so much a indication of a recession. It's not indication of a problem in the existing home business. It's an indication of this mortgage locked in problem. What it means is that all the things around changing homes is recessionary. So when you change homes, a real estate agent gets paid, a mortgage agent gets paid, all the people that are involved in the paperwork get paid. Then you buy new carpet and new paint, and you go down and you buy new furniture. So all the things that are associated with changing from one home to another, that entire sector is currently in a recession.
What you're saying is not a reflection of a recession. This is a causation of recession.
Right, exactly.
Good point. And the corollary of this is the new home, one-family homes sold, the total volume of them, and that's down to what amounts to recession levels. I mean, so the whole new home industry, whether it's all the purchases around it, or the building of it and the building trade of it, all of that is down at almost recessionary levels, if
And
not.
this is an interesting one, Larry, because it's also a reflection of people not being willing to take on that higher mortgage rate. So
Right.
if you're sitting on a 3% and you want to move, and you're like, I'm going to take on a 7% when I'm sitting on a 3%. Well, maybe I can put off that move. But it's also a reflection of the fact that the builders haven't been building. The builders have moved into the multifamilies, and we'll talk about the multifamilies in a minute, because it might be one of the most important issues that's happening right now in the market.
Yes, and just before we get on to multifamily, if we look at the median price year-over-year percentage change, I just make an observation that the percentage change is not really going to be that great at the current moment, because the actual sample numbers are relatively small.
Right.
But the difference in price has actually gone up as much as 5%, is back to kind of the 5% mark after collapsing and now kind of reviving a little bit. So even despite the interest rates, we are at the 5% mark, which is kind of the norm, right?
Yes. Mm-hmm. Yep.
Auto sales are down. I mean, auto sales, the spike, this absolute, catastrophic drop during the pandemic, and then the spike after the pandemic to adjust, and then the drop after the spike. It looks like we're back to some degree. I mean, normal high should be 17. Normal should be around this. It looks normal, but my reports from the dealers show dealer inventories rising at an alarming rate. I think we're going to see this number plummet. That's my expectation, but I could be wrong. The auto companies had a great quarter last quarter,
Right.
and they're reporting, generally pretty strong sales. But auto companies sell to dealers.
Yeah.
Dealers are the actual inventory holders. So auto companies' results are generally a quarter behind of what reality is.
Right.
So I'm not sure that this is a good trend at all.
The interesting thing about the chart, of course, is that our population has gone up dramatically since 1980, and yet our auto sales are about the same. I think this is primarily a reflection of, in 1980, if my car had 100,000 miles on it, I was going to get rid of it, probably before it was 100,000 miles. And today, when you're at 100,000 miles, you consider it to be still in its prime. So there's been a big difference in how long people hold on to cars, and that probably is why we're still in this ballpark in terms of 15, 16,000 per year.
Yeah, and people have talked about peak auto for a couple of years.
Mm-hmm.
I don't think we're at peak auto. I think that that's a misnomer. But everything changes when we get full self-driving and we get robo taxis. And so It's an open question, but you're right. The population in 2024 is higher than it was in 2015, and it's older.
Yeah,
So that's another factor, the age of the population. And the other thing is younger people are not driving anymore.
right.
I mean, it used to be you'd get your license at 16 and you'd want your car. Today, there's kind of a surplus of cars within the family. So it's a very interesting dynamic. But you know, the auto industry is surprised many times. It has always been very difficult to foretell.
Yeah.
Always. And here's an interesting slide. This is from Piper Jaffray, actually. And this you've spoken about often, Randy, and this is kind of one of your favorite subjects, and this is the area that you're probably the best, more experienced even than Cathie. And this is the real retail trade inventory. This is not dollars. This is actual goods in retail inventory. And what is this slide saying to you?
Yeah, so actually I've just been paying attention to this one for the last couple of weeks. This has been a surprise to me. What we're seeing here, of course, is we had this tremendous dip in inventory because people went and cleaned out all the toilet paper in the stores during the pandemic, and they cleaned out everything else. But then as the pandemic moved along, people had the money and companies started to buy like crazy. We get into this boom bust situation. I thought the bust was all over. I thought we were back to normal. The Fed chairman said 2 meetings ago, he said, we're back almost to normal. He's incorrect. And this might be the main reason we might be headed for a recession is we are still 9% above even the trend line, much less normal. We're above the trend line, 9% above that in terms of retail inventories, which means all the retailers who went out and overbought because they were afraid they wouldn't ever be able to get it again, they have not moved that inventory through their stores. They are still sitting on a big bunch of it. They were still nervous and probably still buying some even last year, but now in this year, they're sitting on a 9% overhang. That overhang is going to back up now into wholesale. And then that wholesale overhang is going to back up into manufacturing. So if the retailer doesn't need it, then he doesn't buy it from the wholesaler. If the wholesaler isn't moving his inventory, he doesn't buy it from the manufacturer. So there's still an overhang here, and the price is going to be paid in future months.
And here's the issue. This is not dollars. This has got nothing to do with inflation. This is actual widgets and
Refrigerators and stoves and cars. Well, not cars in this case.
not cars, and actually I think this is the same for cars.
It probably is, but this
I
says
honestly believe it's the same for cars. I think that everybody is grossly overstocked.
right.
And you know what tells us that? Tesla. Tesla does not have a dealership,
Right.
full of cars. We see within Tesla what's happening. So I think that what we are faced with, and I don't think it's limited to the United States. I think this is almost a global phenomenon, which is why China is hurting so badly right now.
There's another piece of this, Larry, that people that have not been involved in retail or wholesale don't understand, is that inventory in your home or in your business also counts as inventory. So if I'm in the recession and I'm thinking I need a refrigerator, and now I can't find a refrigerator, so now I'm really getting excited. I really need to buy this refrigerator. Then everybody who even thinks they need a refrigerator go out and buy one. The retailer goes, oh my gosh, look, my business is up. My business is up. I need to buy more refrigerators. So they overbuy. Well, now everybody that needed a refrigerator has got one. And it takes a while before the next group of consumers is like, oh, my refrigerator's acting up. I need one. This is a problem. And then, as we just pointed out a minute ago, when people aren't changing homes, they're not as likely to go buy that new refrigerator too. So it's a big quandary. And I really missed this one, Larry. I really didn't pick it up until a few weeks ago. the tremendous amount of retail and wholesale inventory in the pipeline still needs to be worked through.
And I think that, I can say with fair certainty that that if you added what you call the inventory in the homes, if you add the backlog or the backlog of desire, of
Yes.
requirements
Yes.
in the homes to this slide, that red line would be even higher.
Yeah. Yeah. We
So,
certainly, everybody knows I'm in the bicycle business. We're seeing it totally in the bicycle business. Most years where there were boom busts, it took 1 year before the consumer came back. This time we are over 2 years into the boom bust. The bicycle business has not come back. That consumer doesn't need that new bicycle yet. And we're going into the new season. I'll be reporting as we go along whether these bicycle consumers come back this year, but it'd be interesting to see, do they come back now in the third year?
so we should have a bicycle graph
We should.
that you should update, get 10, 20 bicycle retailers and, ping them and say, what are sales looking like? Because if we can get 1 week or 2 weeks or 3 weeks indicating that things are picking up again, then we can, turn the recession indicator back.
There you go.
But right now, I've been pressing Randy and saying the recession is coming. I've got a coffee bet with, Yaman. And I'm convinced that it's here or it's coming. And Randy's been pushing back at me. Yaman's pushed back on me. But now Randy's in my camp.
I have gone to 65-35, Larry, 65-35 that we see some kind of recession later this year. Cathie Wood, of course, totally in your camp. She believes it's going to be a harder splashdown than people think. Yeah.
Yeah. This is the indicator. This is the strong indicator. So moving on. Real-time rent versus CPI rent indicator. And, this is just an indicator of how much, in the clouds the Federal Reserve is. I mean, because what this is showing us is, what is happening in rents in real time versus what the CPI is reporting. So, if we look at these two lines here, this is where the Federal Reserve, or not the Federal Reserve, but
where the federal government.
Where the CPI rent indicator is at. But really, where is the rent and primary indicators in real terms? That's the Zillow rent, and that's the apartment list rent. Yes. In other words, somewhere here is where real rents are, and this is the rent embedded in the CPI.
Right.
So, I think what our point is that we need a much better way the Federal Reserve needs a much better way to test what is actually impacting inflation. Their answer is, look, historically, we've always used this number, and therefore we should be acting against that historic number based upon the patterns that we've seen in the past to apply them in the future.
Yeah.
Well, that's actually quite a specious argument, because your indicators in the past were errant. Why use the errant indicator in the present? Let's improve. Yeah. There's room for improvement, don't you think, Federal Reserve? Anyway.
Yeah. And by the way, as we'll see in a minute, I think every indication that these rents are going to be even more of a downturn.
Yes, exactly. So now we can look at what Cathie calls market signals, and these are signals that she feels, and I think it's fairly apparent, are signals of what is coming in the economy. Instead of looking at past history, from economic activity, let's see what the signals say are coming and what has historically impacted on what's coming. We start with the dollar. I mean, it's been moving up ever since, actually, since the collapse, actually.
Right.
of 2008. And it's been moving up. I mean, the dollar, it's amazing how resilient the dollar has been through all the years. You know, there was the collapse in 1970 when they went off the gold standard.
Mhm.
But ever since that time, it's moved up and down. In, you know, I remember, I remember when the euro was instituted. Friends of mine, we were in Europe at the time, and some European friends said, "Oh well, euro is going to crash the dollar.
Yeah. Yeah.
Europe is the new power. Europe is going to crush the dollar. This is the end of the dollar." Yeah, I don't know how many times in my lifetime I've been told that we've now seen the end of the dollar. You know.
I think Cathie needs to get a new chart based on Elon Musk's analysis. I think she needs a new chart which shows population growth versus GDP growth. And I think that maybe, Larry, you could work on that one. You like to put these things together and take
Yep.
a look at European countries or Europe as a whole. Look at Japan, look at China, look at Russia, look at GDP growth versus population growth. The United States' population is growing only because of immigration, but people want to come here, so we are having immigration. But some of these other countries, Japan has always been against immigration. They've only begun recently to bring in some folks. And these GDPs are not doing well, and the American GDP is doing well. I think there's a real a real likelihood that we could prove correlation.
Yeah, I think you're absolutely right. I mean, GDP is always correlated to population. You know, in some countries, GDP has not been as correlated to population as others, but in general, it is correlated to population. If it's not correlated to population, then there's something seriously wrong with the social or the economic organization of that country. So, you know, yeah, it'd be very interesting to do that. And and but you know, Africa's population has been grown dramatically, and its economic growth has been anemic.
Well, that would be to your second point, though, that
Yeah.
sometimes it's about governments, it is about the way governments are run, et cetera. But go ahead. Yes, all right.
Right. So
But the dollar's strong. Yeah.
the dollar is strong, has been strong, remains strong. I mean, clearly this happened. What happened here was all about the coming off the gold standard. The spike in 1980 was, of course, you know, several currency crises globally, and of course the 2000 the
.com bust.
2008 collapse. But we're back, and pretty strong.
Yep.
The commodity index. This is a very, very important. And this chart is actually in current dollars, not in constant dollars. The point is that
Not adjusted for inflation.
not adjusted for inflation. In other words, this is, you know, whatever the dollars are, that's what the price is. But if you actually look at inflation over this time, these commodities are actually coming down in value
Right.
quite dramatically.
Yep.
And you know, you'd have to go back to before 1970 to see any actually, because you know, if you take inflation from 1970 to 2024, I think you'll find that inflation has been, you know, dramatically higher than the
That's
rise in the
Oh,
commodities.
8 to 10 times. I think you're going to have another chart on that. But Cathie Wood made the point that some of this commodity lower value in commodities or lower dollars in commodities is because of productivity. So it's we're able to get the metals out of the ground less expensively than we used to be able to. You're able to buy it from more places, more countries, so there's more competition. But part of it, right now at least, because if you just look at the trend line over the last 2 years, you can see the commodities just really collapsing rapidly.
And the collapse rate is going to increase dramatically as we move from a molecule-based economy to a, electron-based economy. Because when you reduce the use of molecules, then the demand for you're really reducing the demand for commodities.
Right.
And so what you're going to see, other than food, and so you're going to see a collapse in demand, particularly for oil, and oil makes up a big slice of that commodity supply, and that's going to result in a further collapse in this basket of commodities.
Right.
And now some commodities may go up. Lithium may go up, for example.
Right.
But lithium is not even a decimal point of the total commodity basket. And then this slide is the metals to gold ratio versus the US 10-year Treasury. So this gets a little complicated. So metals to gold is the price of metal versus gold. And then this is the 10-year Treasury yield, the yield, interest rate yield. And look at this departure right now.
Yes.
Versus this very close relationship. And even before 2008 crisis, even though they weren't tied together in value, they were tied together directionally.
Right.
So here we're seeing with this departure, it's telling us we're in a deflationary period.
Right.
Just another indicator that Cathie and I were right and Randy was wrong.
I said 50-50. I was
just kidding, Randy, just kidding. Who,
me defensive? What?
Yeah, and then gold. It's gold is breaking up. I mean, we just hit a new high, right?
Yes.
The new high. Just
we are the new high all time.
Yep, yep. And so this is a flight to safety, right?
Yeah. Yeah.
And what do you think the most? What do you think is the most? And Cathie didn't say this. This is just my idea. Yeah. What do you think is the most important driver of that flight to safety?
Well, generally speaking, we've talked about it in terms of inflation, but we're going into a deflationary, or we're disinflation. We're in a disinflation, which you normally wouldn't think would be a flight to gold.
I think it's China.
You also, huh?
I think it's China.
You think it's China? Worry about China?
No. Chinese people worried about China.
Oh, people buying gold. Chinese individuals buying gold. Do the Chinese population, do they have access to the gold market?
Chinese population, they have access to everything. So in Hong Kong, there's probably means to access gold.
Right.
I think we are seeing, traditionally in the last 30 years, prior to the Trump administration, I would say, Chinese, always had kind of what they viewed as escape hatch by accumulating foreign assets and being able to move to foreign countries.
Right.
That kind of escape hatch is closing down. It's very difficult now in China, I think, to accumulate foreign assets. And so I think
the foreign assets are expensive.
Yeah, of course. Well, even gold is expensive now for China, but it's not a question of whether they're expensive or cheap. It's a question of absolute need.
Right.
And I think that what happens is that it starts becoming accumulating gold. I need to investigate this because it's just somewhere in the back of my mind. I mean, I wouldn't be surprised if that's happening in Russia as well, but I think
you could add to your thesis by everybody knows that the individual middle class Chinese were investing in property in China That was the thing that the government wanted them to invest in. And so that's where people's pensions were. I mean, that was what they considered to be their retirement, was their second or third apartment that they owned someplace. But of course, that has collapsed completely. And so that would be another reason why they would be looking for an outlet. And if gold is reasonably accessible, that certainly would be a direction.
Yeah, well, yeah, and do they squirrel away currency like dollars, or do they squirrel away gold, or do they acquire a foreign bank account or foreign property? I don't know, but I think that gold is one of these portable, immutable,
Right.
immutable assets, as is Bitcoin, by the way, which is another issue. So it's interesting that in the time of Bitcoin, gold is still able to, rise. So we'll see. It'd be interesting to know what is driving this gold price. But I think the gold price can still go higher, and I I continue to. Although honestly, I think that if one is going to be buying gold for these reasons, one might as well buy Bitcoin. It may be easier. I think Bitcoin's become a big competitor to gold.
Maybe, yeah, we'll see.
And that brings up the Bitcoin uh, graph, which actually is well twinned with gold.
Yeah,
Much, much, much more volatile, of
much
course.
more volatile.
Yeah, and Cathie's very high on Bitcoin.
Yes.
Um, it's interesting. There's a lot of debate on Bitcoin, and both sides have a lot of, strong points to make. What do you think?
Yeah, I still haven't read the book. One of my commenters actually sent me the book, and I still haven't had a chance to read it. I really can't take a position on Bitcoin because I still am struggling with. I'm reminded, Larry, of when I was at UCLA. All right, UCLA Law School, and without bragging about it, the ninth best law school in the country at the time, very hard to get into, very bright people. And they got caught up in a, what do you call it? One of these scams
Yeah.
where you paid $10 and that gave you the right to send your letter to 10 people. And if they put $10 in, what do you
Oh,
call it?
wow. Chain
Ponzi
letter.
a chain letter. I mean, these law students got caught up in that, and a bunch of them lost a bunch of money. And I'm looking at, smart people that are involved in Bitcoin, and I'm saying this Bitcoin can only continue to exist and go higher to the extent that people believe in it. And if people don't believe in it, what is the other thing that is going to keep it from having, from going away? If
By
people,
the way, what you're saying is that people buying it because it'll go higher. I think there's a difference. I don't know that people are buying it simply because it'll go higher. And maybe they are. But on the other hand, I think there's a value in Bitcoin, that the value of Bitcoin is no different to the value of a dollar note. I mean, why do you think there's value in a dollar note?
well, I think it's because of the full faith and credit of the government that's underlying it.
Well, what about the full faith and credit of all the people who own Bitcoin?
Yeah, but those people are not going to make me whole. They're not going to say, "Oh, you lost your money. I'll send you
But the
dollars."
government is not going to make you whole.
Well, but there's a value. There is a so the it used to be gold was the underlying value for the dollar. Of course, we don't have that anymore, but there is still a huge landmass. There are buildings on that landmass owned by the government. The government owns a lot of land. They own
The landmass and the government are two separate entities. The government is a conceptual entity, the landmass is a physical entity. The relationship between the two is political.
maybe someday we should do this as a separate show, Larry.
Yeah, yeah. We can have a long conversation. But I'm
Yeah, Kathy.
convinced that there is as much backing, that there's a difference in quality, but there is no difference in the nature of the relationship between Bitcoin and its value than there is between the dollar and its value.
Again, I think we should probably move it to a different time. Maybe we'll get Cathie Wood on to help us. I
Yep. Well, she'll be on my side, so you're in trouble anyway.
know, I know.
So there we are. Bitcoin's back to its high. It's following a pattern. I mean, this time is different because there are some, funds that are quoted on the stock exchange. There's no longer there's kind of a regulatory. There's been a lift of some regulatory, limitation, much against the government's will. And for this, we have the courts to thank, by the way.
Yes, yes. And the
And so,
institutions and the institutions now might take a harder look now that the ETFs are available.
well, they have taken a harder look.
Yep.
So some of the largest institutions in the country are behind it. And so I think we have a way to go. Not investment advice, but I think we have a way to go with Bitcoin. But Bitcoin is always going to be very, very volatile. It's going to remain volatile until it has a much wider appeal.
Right.
But there are reasons that I think Bitcoin will remain strong, and we don't have to discuss it now, but I don't actually subscribe to all the other coins, by the way. I think that it's unique, that Bitcoin is unique in that regard.
Okay.
And then we're looking at credit default swaps, and this is a little complicated, but it's comparing high yield bonds with credit default swaps. And in theory, the two should be aligned.
Right.
Because they're really the same instrument. The credit default swap is kind of an insurance instrument against a long-term bond, and they should be the same, right? So here we see that there's a gap, and that gap indicates there can be a serious problem. As you see in this period of time, you see during the quiet period of time, there's pretty close alignment, but when there's a gap like this, there's real tension, and we don't fully understand it. But it could be what Cathie calls fireworks.
Yeah, she also mentioned that the fact that it is trending down was surprising to her. That she would have expected right now that the insurance would be going up, not going down. Yeah.
Right. And why do you think that is?
Yeah, she didn't know. She's literally said, "I don't know," which is unusual for her. She usually has at least one idea.
Yeah, and I mean, she does point out that a lot of these bonds are supporting, commercial buildings,
Right.
and office buildings and retail buildings.
But
And
that would mean it'd be going up, Larry. That if she's
yeah,
concerned that
but
that's a problem.
the truth is that they haven't been correctly marked to market.
Yeah.
So that's why they're not going up. And maybe there's a huge gap building between reality and how they are marked. That
Right.
is to say, how they are represented in the books of the companies that are holding them.
Right.
And when those have to be adjusted, it could be a collapse in the
Well,
market.
she also did mention that there is a lot of money pouring into investment grade uh, private opportunities. I'm assuming I'm not as clever in that area of the business as you might be. By investment grade opportunities, is she talking about things like SpaceX, Neuralink, et cetera? Are those investment?
No. Investment grade opportunities are quite the opposite. Investment grade opportunities are companies with very high levels of liquidity that are raising money. So those are investment grade.
I see.
So, but Tesla is investment grade, for example.
I got you.
SpaceX probably would not be because it's a private company, although it could be because its assets are very well covered. I don't know
Okay.
that they would ever issue a bond. It's very unlike a private company to issue a bond, a investment grade bond.
Got it.
And then, so that really is Cathie's summary of the
Oh,
economy.
let's stop then for a minute, Larry, because maybe there wasn't a slide on this. Maybe she made it as part of the discussion. I thought one of the most important things that she brought up is the overbuilding of apartment units. We've talked about this a little bit, or at least I have on my channel on this channel. There was a beginning of an indication that there was apartment building oversupply of apartment buildings starting about 6 months ago. That's one of the reasons why we see the drop in the rents, is because there's just too many apartment buildings out there right now compared to the number of people seeking an apartment. Well, that number is going to get worse because there's 1 million units of residential units in the pipeline coming up in the next year. And when you've got oversupply already and you're going to add another million, then rents are almost certainly going to be in trouble, or they're going to go down, which is good for the population, not so good for the investors. Well, so that is, of course, going to impact inflation and potentially be a big impact in a deflationary situation, to your point. And then in addition to that, it is going to put additional pressure, potentially at least, and she's starting to see this, putting additional pressure on the regional banks who are already this is where they make a lot of their money. The regional banks are the ones who loan the money to these local apartment building owners, and they're going to come under pressure, and you've already got the pressure from the office space. So the commercial real estate thing is now going to have a double whammy, and the impact could be really troubling for small banks. And she was very, very nervous about how this could impact the small banks.
Particularly with the Federal Reserve program ending in
Yes,
the coming week, on Monday, actually.
Monday, right.
And then you have these pressures arising. Commercial buildings are already in trouble, but when you have all of this rental property coming onto the market, where's the money come from those rental properties? All from these small to medium sized banks, or it's backed by long-term bonds. So when you look at these small to medium banks or local banks, and you're looking at what's supposed to be high grade paper bonds,
Yes.
then this fall in cost of insurance of those credit swaps make no sense at all, and we could see another spike like this. So
Yeah,
I think
we've seen this story before, where the overbuilding in apartments happens. This is a kind of a surprise to me, but she says what it was people chasing yield. 3 years ago, 2, 3 years ago, you couldn't get, the yields were zero. They were less than zero. And so people that had cash went seeking yields. Well, so one of the places they thought they could get those yields was in apartments. And they went and bought a lot too many of them, and they bought them highly leveraged. So they didn't go in with 60%, 70%. They went as high as they could go.
it's worse than buying them. It's building them. If they simply bought them, that would be one thing.
Yes, I also built them. Yes.
They built them, which is adding to the supply,
Right.
where the demand may not be there. Now, who knows? I mean, maybe all these immigrants coming in will actually rent them, or the government will rent it for them.
Right.
But it could be disastrous. That's one of my points about the recession, the coming recession. Most of these recessions come by surprise.
Yes.
They come because the actual, triggering event, what actually causes the recession is unforeseen.
Yes.
The conditions for the recession exist, but the triggering event is unforeseen.
Yes.
And this is just one potential triggering event. When you get these, these huge discontinuities in the economy,
Yes. Yes.
that's what worries me.
Yes. And in fact, we've seen in this report today, we've seen several of them. We've seen the apartment
Yes.
rents, we've seen the employment numbers, we've seen the temporary employment numbers, and we've seen that inventory number, the wholesale inventories, retail inventories. These are things I think which are surprising, and this is why my underlying opinion has started to change to the 65-35 recession, because these are, as you said, we're seeing a correlation. We're seeing a number of different pressures all heading the same way, which is deflationary as well as economic difficulties that will impact these regional banks, et cetera, et cetera.
Yeah, and I have a coffee bet with Yaman,
Yep.
which I'm about to lose. I said the recession will come in March. We're already a third of the way through March, and it hasn't really hit. But that's the problem about the timing by month of a
Yes.
recession.
Yes.
Recessions don't typically occur because recessionary pressures exist. They typically occur, well, they often occur from a precipitating event.
Right.
And so we don't know what that event is going to be, but it's going to happen. But if one happens, there will be a recession. And one always happens when there's all these pressures and these discontinuities in the economy. But Cathie tells us not to worry.
That's right.
She has a letter coming out, and everybody should subscribe to that letter or get that letter from the ARC website. And in that letter, she and Brett Winton, who is I think, chief futurist, they call him,
Uh-huh.
are going to be talking about these, these huge these huge
Disrupting
innovations,
right, innovations, right,
that are coming to the economy that's going to solve this problem in the long term, because the event is threatening to bring about a significant amount of deflation in the economy, and these are very worrying times because, as I've said before, deflation is much worse than inflation.
and her point really goes back to this productivity. She is a big productivity fan, like I am, like Siegel is. This productivity thing, it's always going to be the thing that brings wealth to individuals, brings wealth to companies, bring wealth to governments, and so, or to the governed, to the country, if you will. So the more productivity you have, the more wealth you have. It's just an absolute straight line. It's not even debatable. It's almost like 1 + 1 = 2. So if we get this dramatic increase in productivity, which it appears that we're seeing all kinds of evidence of it, then productivity will generate even if we go into a 3 or 6 or 9 month recession, coming out of it is going to be absolutely bonkers.
Yeah, the biggest worry is deflation, recession, and deflation that follows it, a long-term, deflation. And the biggest opportunity to come out of it is this opportunity of huge, and overriding productivity. And productivity will bring with it the potential for unemployment, but we will see a huge change in the workforce and how it's deployed and the opportunity that brings. So it's an exciting time. That's the Chinese curse. May you live in exciting times. So I think we may all be cursed.
I'll put a link to the letter in the information below in the description.
So it is not available yet. It's due.
Oh,
She's
Oh,
It
you're
was?
talking about the future letter, because she also put out a letter yesterday. That there was a letter yesterday. She did mention a future letter that's going to come out later this month, but there was also a letter that was sent out yesterday, and I'll put a link to that one.
Okay.
All righty then.
Well, I hope this has brought some degree of light to. I mean, it's not a great message we give.
No, it's not. It's not Randy's happy news. But I really, Larry, you and I may have said this before. Recessions are cleansing. I the other day had to have a tooth extracted. I didn't want to have my tooth extracted, but if I hadn't had that tooth extracted, I could have died from an infection, right? You got to sometimes you have to have the extraction, and then you make the correction, and then you move into a better time. And so recessions are necessary. They get rid of excess. They get rid of people that have gotten out over their skis and are doing the jobs they shouldn't be doing or owning the companies they shouldn't be owning. And then you get into a new period where people are more in better alignment with what they should be doing. So anyway, that's the hope. That's the good news.
That's the good news. And better news would be if people prepare themselves accordingly.
That's right. Cash, cash, cash. Having your cash ducks in a row is always the number one thing to do and prep for a recession. In fact, I claim that the reason we haven't already had a significant recession is because everybody was talking about the recession for so long that small businesses, medium-sized businesses all went out and built up their cash and prepared themselves. And as a result, they had cash when the problems hit. And that is being proven out by, in fact, the small business statistics will be out here next week, Larry, again. And what we've been seeing in all of the statistics is that the small business owners don't need loans. They're fine.
Yep. It's kind of saved the banks. It's kind of saved the small businesses. The recession, not a recession, the pandemic was a wake-up call. And the government pumped a lot of money
Yes.
into those small businesses. And so all in all, the small business guy who normally takes it straight on the chin in these circumstances, he's done okay.
Yeah,
He's done.
that's right. All right, Larry, it's been great. I enjoyed every minute of it. And to all of you out there, hope you did too. And it's been great talking to you.